What is the market right now misunderstanding about the Fed and other central banks?
I think the major issue is that the market has become overly data dependent, just like our central banks have become overly data dependent. So we're not looking beyond the next data release because we're worried about what will the Fed do in September, what will the ECB do in September. But as Christine Lagarde said at Jackson Hole last week, there are real consequential longer term issues that are unanswered and that we need to spend a lot more time on.
But what do you think these are? We're starting to look, some of the loan books maybe, be a bit of a concern. We're starting certain companies under pressure and defaults in Europe and in the US.
So you have to start at the highest level, which is we are in a different global economy. We are in an economy facing insufficient supply as opposed to insufficient demand, which is what we had in the last decade. The minute you start with that, then rates are going to be higher for longer. Then you have all the commitments that were made when rates were very low that have to be refinanced, whether it is commercial real estate, whether it is the indebtedness of certain companies that have to be rolled over. And then if you keep on going, you end up with three very different risks. For the US, it's about financial fragility in the non-banks. For Europe, it's about stagflation. And for China, it's about deflation. And it's a very different fragmented outlook than what we've had before.
I mean, for the U.S., it's basically shadow banking that you worry about. How difficult, how ugly could it be if we have some kind of financial event?
So the good news, it shouldn't be ugly because a lot of these things are refinanced over time. They don't fall immediately unless, like we saw in March, depositors or someone else worry. But commercial real estate happens over time. Corporate refinancing happens over time. The problem is that if the markets don't fully understand that, and then you get the drip, 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 and then suddenly there's a critical mass. But I think we have time, but the reality is that central banks are just catching up to the fragilities in the non-banks. They understand the banks relatively well. It's the non-banks that they're having problems with.
But what can they really do about it if they still have to stick to 2% inflation? Should they, without saying it, maybe stick to 3% inflation or trying to get it down maybe at a slower pace than they're currently trying to?
So that question is being debated hotly among economists. Central bankers don't want to touch it. We heard Chair Powell say 2% is and will remain the inflation target. In reality, it is an open question. What is the right inflation target in a world where the supply side is changing? And it's changing on account, as you know, of many things that are multi-year.
But why do they not want to talk about it? Because it's a credibility concern if they start talking about it.
Yeah, history is full of examples, unfortunately, where a central bank changed its inflation target when it has missed it. And that de-anchors inflation expectations. So if you've missed your inflation target for so long, which is the case for the Fed and the ECB, the last thing you want to be seen to do is to change your inflation target.
Mohamed, what's your take on China? Do they have the correct, I mean, it's bumpy, but do they have, at the margin, the correct policy mix?
No. I mean, what they're doing is piecemeal. Today, we had another set of piecemeal measures. They're not gaining traction. In fact, if anything, they're exposing inconsistency within the economy. The problem with China is a growth problem and a debt problem. And the growth problem needs a revamped growth model, not just tinkering with what you have, but fundamentally changing what you have. And the debt issues need fundamental restructuring. Otherwise, pockets of indebtedness will become systemic.
Or is there any actually signs that President Xi is looking to do that, or does he look too weakened now?
I don't think he's too weakened. I think it's a question of biting the bullet and going after major structural changes. It's not easy. It's not easy. Right? I mean, the West has as much difficulty doing this as China does. But most importantly, it's pushing down the drivers of growth to the micro level. Instead, they've been pulling them up to the macro level. But
Mohamed, we've been talking about this for such a long time, right? That China has, it's like moving a massive oil tanker, that it's painful and difficult to do. And we haven't really seen the signs of that yet.
Not this time around. I mean, so that's the big difference, is in the past, every time China has hit a soft patch, there was a lot of learning and a lot of course corrections. This time around, it's been a different process. And that's why the markets haven't given full benefit for the measures. Again, today, we saw the benefits fade very quickly. Last week, it was about the stock market measures. That faded very quickly. So, the market is now starting to doubt that China can actually deliver in a consistent fashion. And that should be of concern in Beijing.
But is the market actually pricing in the spillover of a possible China downturn?
Not yet. Not yet. The view is still what happens in China will remain in China. But slowly people are starting to realize. So Germany, for example, is a perfect example where there are spillovers. Chinese manufacturing is being impacted by what's happening in China.
But you disagree with that. So you think there are concrete spillovers if China were to get worse economically?
I do. I mean, I think the two major spillover risks that aren't fully priced in, one is China and the other one is Japan. The exit in Japan from yield curve control, which has to happen, hopefully happens in an orderly fashion. If it doesn't, that will also have a spillover effect.